Hello and welcome to Cafe Mutual YouTube channel. Friends, we all know that different asset class outperforms in different market scenario, and it is difficult to predict which asset class will perform in a particular year or the next. So in such a situation, practicing asset allocation is very important. But what if a fund, if what if a fund that can invest across all asset class and take care of your asset allocation needs? Yes. So Union Mutual Fund has launched Union Multi-Asset Allocation Fund that will invest in equity, debt, and gold. The fund will also have leeway to invest in commodities like silver as well as real estate through REITs and InvITs. So to throw more light about the fund and multi-asset allocation category, we have invited Sanjay Bembalkar, co-head of Equities Union Mutual Fund. Sanjay has close to 18 years of experience in equity research and fund management. So without wasting time, let's invite Sanjay. Welcome Sanjay to the show.
Thank you. Thank you. It's a pleasure.
Sanjay, my first question is on everyone's mind today. So what is your medium-term outlook on equity, debt, as well as gold? Since you are launching the multi-asset allocation fund, we want to understand about all three asset classes from you.
Sure. Since we are discussing this in the light of our launch of multi-asset fund, let me go back to how we designed this product. When we designed this product, we thought about one philosophy, one word philosophy, which is there is diversification. And on that philosophy, we have designed this total product as such. When we went to understand what are different asset classes and how they interplay with each other, we clearly identified there are two types of asset classes in the world. One which is derives its value from very scarcity, which are called scarcity assets like bullion, gold, silver, or vintage cars. And there is other asset class which derives its value from the efficiency of assets. These are efficiency assets, which derives its value from the cash flow the companies generate, and they are debt and equity. So these two asset classes typically, as they derive its value from different factors, they interplay with each other with limited or negative correlation. And that's the hypothesis. And that's the basic of launching multi-asset allocation fund as such. And now going back to your very question about the outlook, we typically look at equities, debt, and gold. And particularly from Indian context, I'm talking about our outlook on Indian equities from the medium term is derived from two aspects. One, fundamentals of equities, and second, flows which are occurring in the equity markets currently. So India's fundamentals are quite strong, which we all know. India is one of the fastest growing large economies in the world. And even government's focus on making India as a manufacturing hub bodes very well from the overall economic and companies' perspective. And as companies' capacity utilization is also now hitting the higher end of the spectrum, operating leverage is likely to play over a period of time. However, in the medium term, demand and supply is the dominant factor, particularly from the Indian equities perspective. And as you know, FIIs as well as domestic institutional investors are quite focused and the flows are quite strong. They are dictating how equities are behaving in the medium term, in our opinion. So Indian economy as well as the flows are likely to behave in a positive way, positive direction. And that's why we have quite good outlook from the medium term perspective. However, in the medium and short term, there are certain pockets of froth, particularly in the mid cap and small cap, which we are worried about. And that's why we believe large caps are having better risk reward at the current juncture in the overall Indian equity markets. On the bond as well as on the gold, particularly, let me talk about bond first. We are looking like we are at a cusp of a start or we are starting on the interest rate cycle, downward cycle of interest rates. And Fed is likely to cut interest rates in this calendar year, which will have a repercussion on all the other central banks as well, including India's RBI, which should cut the interest rate once we get clarity from the Feds. And in our opinion, as interest rates are likely to go downwards, that should have a positive repercussion on the bond prices and the bond returns. And that's why even on the bond side, we are quite positive on the overall Indian bonds market as such. And thirdly, on the gold, if you look at last 10 years, what has happened is that gold and equities, as you rightly said in the first comment, that they outperform at a various different times in the market. And that is clearly defined by the factors in which these derive their value from. On the gold side, we have seen when there is a when there is a global macroeconomic changes, particularly on the interest rate, or there are any crisis which leads to different outcomes in terms of GDP growth, or if there is any currency related volatility, we have seen gold outperforming the other two asset classes. In last 10 years, almost 4 out of last 10 calendar years, we have seen gold outperforming. And that is the result of increased volatility in the overall market context. We believe because of the increased volatility currently and geopolitical scenario which we are having, we are optimistic about gold outlook as well in the medium term.
Okay. So generally, Sanjay, we have seen that gold is known to have negative correlation with the equity market. But however, gold has performed at par with the large cap index or equity in the last 5 years. So what is the reason for this correlation, and why do you think that gold still makes sense for diversification?
Sure, sure. No, it's a very good observation, I must say. And if you look at if you dissect those 5 years into every single individual year, you will find that gold has significantly outperformed at the time of COVID times, when there was significant uncertainty in the global markets, global world, as to what will happen with respect to growth, what will happen with respect to uncertainties which are there. And again, after 1 year, again in CY22, gold again outperformed materially. And currently also, if you look at after geopolitical scenario, which is changing dynamically every day, we are seeing gold again outperforming. So these are the three time frames in which gold has given significant returns. And considering the starting point where we are looking today, that geopolitical scenario as well as interest rate scenario is likely to change materially, we believe that gold will have a bright future in the medium term as well.
Okay.
And that also goes back to our understanding in last three cycles, what has happened, particularly in the if you look at 2001 cycle, 2007-8 cycle, and 2020 to 22 cycle, when there was an interest rate cut by the Federal Reserve, we have seen significant rally in the USD gold prices. And we believe, since we are again at the cusp of interest rate downward cycle, that those last three cycles may repeat going ahead.
Okay. Sanjay, Amphi data shows that the AUM of multi-asset allocation fund has tripled in the last 1 year. So what are the key reasons for the popularity of multi-asset allocation funds among investors as well as distributors?
Sure, sure. So multi-asset, on one side, it provides diversification. On the other side, the very positive side is also that it has a very significant bearing from the behavioral finance perspective. If you look at, typically investors have recency bias. One strong rally in one asset class leads to over allocation of that asset class in the portfolios of individual investors. And also there is a fear of missing out. If one asset class goes up, since there is a concentration in that asset class, the other asset class is typically neglected. And when the other asset class starts rallying, there is a fear of missing out, and then the big rush happens to allocate into that asset class. So this product, because of its diversification and allocation into all these three parts of assets, which is equity, bond, and gold, provides a good diversification, and there is no fear of missing out from the investor's perspective. And since the starting point which we discussed about, the starting point of the equity market, we are on the slightly on the expensive side of the equity market. I believe investors are also looking to allocate money where they find that incrementally there is a margin of safety, there is a good hedging which is available as against equities, and also with respect to geopolitical and currency and interest rate scenario, if gold as an asset class is likely to be a good hedge going ahead. That is what I think investors are looking at when they are allocating more money to the multi-asset allocation strategies. And we believe, as geopolitical scenarios as well as macroeconomics is going through a lot of volatility, it makes perfect sense for investors to consider this as a fantastic strategy to diversify away from only one asset class if they are over allocated to one asset class.
Okay. Sanjay, Union Mutual Fund has launched Union Multi-Asset Allocation Fund. So what's the rationale for this launch, and why do you think that this fund is, unique in the market?
So let me delve deeper into the individual strategies which we are likely to implement. We are planning from equity, bond, as well as from the gold perspective.
Okay.
though this fund is an equity-oriented fund where gross allocation to equity is 65% to avail the benefits of equity taxation, we are planning to have net equity exposure between the range of 50 to 70%. So we will be using arbitrage or derivative instruments to reduce the gross exposure from 65 to 50% if our view on the equity market is negative, and we are likely to increase it to the range of almost 70% if our view on the equity market is positive. That is how this product will dynamically change the allocation in the equity portion of its of the allocation. So we have in-house asset allocation model, which we are anyways using from balance advantage fund and equity savings product. And now this product will also dip into that expertise of asset allocation, and we'll use the same model to allocate equity portion. So that model considers equity outlook on the fundamental side and also combines that with the momentum outlook, which is derived from flows and sentiment. And these two components are used to understand where our equity allocation should be. So dynamically changing the equity allocation has also shown in our backtesting has been big beneficiary to the investors, and that's what we will use in our equity component. On the debt side, we plan to allocate at least 10 to 15% of the allocation to debt, and there since we are at a cusp of a interest rate downward cycle, we plan to have a higher duration in the debt portfolio. So our fixed income team will dynamically manage the duration and the debt component of this product as well. And third piece, which is gold, we wanted to have when we looked at backtesting and when we looked at how Indian investors can be big beneficiary of the overall diversification, we thought that gold, as you rightly highlighted, has been a significant performer in past 5 to 10 years as well. And that's why significant allocation to gold as a diversification and also as a return generator was a big allocation from our overall fund perspective. And we plan to allocate at least 20 to 25% in gold category or on the gold side of the commodity as such. There are two more components, which is silver and real estate investment trust, which are also enabling provisions in the SID. As of now, we don't intend to allocate significant allocation or significant funds in those two categories as of now, since our view is not very constructive in these two categories. Once we have positive view on these categories, we may reduce allocation to gold to certain extent and allocate into silver or allocate into real estate investment trust if that view at that time is more positive.
Okay. So Sanjay, despite being a multi-asset structure, the fund is an equity-oriented fund with over 65% allocation to equity. So what's the reason for this? And within equity, will you be buying large cap only, or it would be a flexi cap approach? Within debt, it would be a short-term duration or long-term. So how you will manage these plays?
Fantastic. So particularly, we chose to have 65% plus allocation from two perspectives. One, on the taxation side, we understood that it has a big beneficial fit to the investors if they get equity taxation as against the debt taxation. That is point number one. And second point also, that equity has been a fantastic asset class from Indian investors' perspective over a long period of time. And we wanted our investors to benefit out of it. And that's why we chose higher allocation to equities. Though, as I mentioned, in case there is a medium-term negative outlook on the equities, we have ability to use derivative instruments to reduce the allocation to equities from 65 to up to 50%. So we can use arbitrage positionings to reduce the exposure to equities when we have that view.
And within equity allocation would be tilted towards last, or how it will happen?
Yes. So equity allocation would be managed in the flexi cap style. We will have combination of large, mid, and small cap categories, which will be present, and it will be diversified portfolio, which will be running in the equity part of the portfolio. On the debt side, since our view currently is that we are at the start of the downward cycle in terms of interest rate, we plan to have higher duration in this fund, which will be dynamically managed, as I mentioned, by our debt team. That is how overall portfolio allocation would be. And in the gold side also, we will be using most liquid and cost-effective ETFs, which are available in the market, to have exposure on the gold side.
Okay. Sanjay, I mean, interesting thing that I have read about gold. So, World Gold Council's website says that beyond 15% of allocation, if you have more than 15% allocation to gold, it may not add value to the overall investment portfolio. I mean, so they are suggesting 15% of the allocation. So, what is your view on this?
So we did rigorous backtesting to understand how gold behaves over periods of time. So as I mentioned about interest rate cycle, there is a clear in last three interest rate cycle that's visible. But even from the currency perspective, as you see, when there is a shift from the global investors allocation perspective, there is a flight to safety. We have seen gold typically outperforms over during those periods of time. And as we are into high volatility times in terms of macroeconomics, we believe that gold outlook from the medium term is quite positive. And even on the backtesting side, as you yourself highlighted, that Indian gold typically has given quite good returns to investors in last 5 to 10 years period of time. To take that benefit and give the diversification through the investors' portfolio, our backtesting suggested that 20 to 25% allocation was a good allocation and significant allocation to take benefit of hedging and also provide the return potential which is available from the gold side. And that's why we allocated higher allocation to gold. Despite the category indicates minimum 10% allocation, we actively chose to have allocation between the range of 20 to 25% in this category.
Okay. Sanjay, currently there are, as you know, that there are many multi-asset allocation schemes available with good track record in the market. So why do you think that MFDs should consider this fund for their clients?
Sure, sure. So from our perspective, it provides you three differentiating points. One, on the equity side, it is an equity taxation product, whereas some of the competing products or peers product are also having debt taxation benefits. So equity taxation benefit is something which we have in this product. Second, equity allocation, which will be dynamically managed. It's not a constant allocation from our perspective. We'll be dynamically managing the equity allocation. And at the time of when our outlook is slightly on the conservative side on the equity, we'll be having lower allocation. And when there is a positive outlook, we'll be having higher allocation to equities. So investors don't have to worry or don't have to get intimidated by managing three asset classes on their own. Here, they are going to get all the three benefits on the equity side, debt side, as well as gold allocation side in one product. And that's why we believe this product makes perfect sense from investors' perspective. The second thing is that on the bond side also we'll be dynamically managing the duration aspects of it. Currently, as I mentioned, we will be having higher duration in the portfolios as our outlook on the interest rate is that interest rates are likely to reduce over a period of time. And gold, which is very important part, which is we are having significant allocation of 20 to 25%. So it's a significant allocation. And these are the three big benefits. So equity taxation, dynamically management of the equity portfolio allocation, and also having significant allocation into gold. And we believe these are the three benefits which investors would get from this product which Union Mutual Fund is offering. And that's what we are looking from allocation perspective.
Okay. Sanjay, one last question. Where do multi-asset allocation funds fit into clients' portfolio? And what is the ideal time frame to invest in multi-asset allocation funds?
Sure, sure. So ideal time frame to invest, our backtesting data has indicated that at least 3 years. However, 5 year would be most ideal allocation, time frame allocation from the multi-asset allocation strategies, because these strategies typically take some of the strategies, particularly in the gold side, it takes macroeconomics into calculation, and these cycles may be long duration cycles. To take those benefits, I believe at least 3 to 5 years should be the time frame when somebody is looking at these allocation strategies. And secondly, on the client portfolios, as this product provides a big benefit of diversification, and one don't have to worry about the fear of missing out from one asset class. And also to take the equity benefits, there is a dynamically management of equity portion. We believe that this strategy makes perfect sense from most of the portfolios from the client allocation perspective. Also, we couldn't have timed it better, to be honest with you, since as of now, mid caps and small caps have given significantly higher returns, and people maybe or investors are sitting on those higher returns, and over allocation might have happened in some of these categories. In our opinion, it may be a good idea to reduce allocation on those side and allocate into these multi-asset allocation strategies as well. So in my opinion, it makes perfect sense from diversification perspective and also from behavioral finance perspective that we don't want to worry about which asset class will outperform over a period of time. You will be party to all the three asset classes of gold, bonds, and equities in this product.
Okay. So, all right, we have come to an end to this interesting session. Thank you so much, Sanjay, for your valuable time and inputs. And all the best for the
Thank you,
NFO.
Nishan.
Yeah.
It has always been a pleasure. Thank you so much for having us.
So it is unique. I mean, the arbitrage part, I mean, you will dynamically manage the equity part. So that's unique in the market. And I hope, I wish you all the best for the NFO.
Thank you so much. Thank you so much.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.